we deliver solutions that are already working, and we don't have a track record of any failed project or failed product. So they just believe that if these guys are selling something, it probably makes sense.
$720 billion is no small feat. The kind of growth that we're seeing, I think 79% last year on year growth in digital transaction values is quite impressive.
Regulated DeFi and regulated blockchain is that you can take those compliance requirements out of the hands of people, like people's discretion.
Welcome to the F Squared podcast. Today, we're exploring one of the most ambitious bets in African payments, Zone, Africa's first regulated layer 1 blockchain network. If you followed Nigerian fintech, you'll know that Obi Emeratom co-founded Appzone back in 2008, a full-stack banking software company that powered everything from core banking to card issuance. But in 2022, they made a bold move, splitting the business in two. Zone was spun out to reimagine interbank payments from the ground up, leveraging blockchain, not hype, but as regulated infrastructure. We're going to cover a lot: why payments aren't as solved as they seem, how decentralized infrastructure can reduce fraud and failures, what truly makes Zone different from both switches and fintechs, and how Obi thinks about traction, monetization, and long-term success. Let's dive in. Nigeria is, I think, Africa's largest fintech market. Between 2020 and 2024, it accounted for around 36% of VC funding. But on top of that, I think last year the stats were that Nigeria processed $720 billion in terms of digital payments. That's like 1 point something quadrillion, which is quite a milestone. Now, of course, maybe inflation could have played a part in that, but it's still an impressive number when you look at just the volume of transactions. And so that, of course, is riding on NIBs, InterSwitch, and all these kind of traditional intermediaries, or intermediaries as we'd call them. And so from outside looking in, it seems like it works and it's a success, right? So maybe walk us through, again, from an outsider's perspective, $720 billion is no small feat. The kind of growth that we're seeing, I think 79% last year on year growth in digital transaction values is quite impressive. And I think NIBS has consistently set a number of records. It seems to me that the market is saying that some of these intermediary issues are not issues at all, right? So maybe you can go deeper and say, like, what were the fundamental problems that the banks were saying, apart from cost, that was really hampering, or at least made them attracted to Zone, right? Because from the outside, it looks like everything else is working perfectly.
Yeah, so I think it looks that way because the demand is there, actually. So for sure, the demand is there because the consumer, the value to the consumers, or what the consumers expect in improving the way they interact with payments is really, really clear to consumers, and has become clear over time. But what has happened is that specifically with respect to reliability, right? First of all, I mean, the challenge you have is when transactions have to flow through this single central point of failure. What happens that anytime there's a failure at that central point, then the entire network is cannot transact. And so that has been an issue. It doesn't take away from the great job that those players have done and the scale that has been achieved. It just means that at whatever scale, once you have that failure, then the entire network is brought to a standstill. That's one. The other is tied to reconciliation and the friction reconciliation, the friction that reconciliation sort of impacts on customers. Typical example is sometimes when transactions are done at POS terminals and the transaction succeeds, at the customer's bank, but fails at the terminal, right? So now you have two divergent positions of a single transaction. In the meantime, the customer has been charged. They don't get value, right? They didn't get the product they want unless they pay again. When they pay again, it means they have some value hanging somewhere. The manual reconciliation process required through these intermediaries it takes time. It takes days. It can take weeks, and that becomes a major pain point for customers. There's very steep competition in the market to deliver the best experience to customers and win customers. So that's a big issue. The other issue is fraud, because the other issue tied to reconciliation is fraud. Unscrupulous customers would always claim that they had some reconciliation chargeback issue, even though they didn't. Now, the central bank put a time limit to reconcile and resolve such claims. If you exceed that time limit, then the assumption is that the claim is accurate and the charge comes against your position. So as a bank, you lose money because you give a refund to a customer that has already gotten value. What you have implemented, the transactions are reliable because there's no central failure point. The chargebacks or reconciliation process are automated because our system is able to detect where there's that divergence and refund customers immediately, as opposed to waiting for weeks or days. And for the fraud aspect, the system is able to reconcile those fraudulent claims once they are submitted, so that they can be declined immediately, and so that you don't have those elapsing, you don't have the timeline elapsing. So this is what was interesting, has been interesting, not just to banks, but also digital banks and fintechs as well, who have been connected to the network and started to process transactions as well.
Got it. And that is a fundamental issue around blockchains versus centralized payment systems, right?
Yes.
This core idea of
Yes.
settlement, reconciliation, and communication, kind of collapsed into one system, as opposed to having separate systems manage that.
Yes.
Now, could you just give us maybe an overview, what's happening under the hood, right? So let's say it's zone day one, and you've got 5 banks coming in, UBA, GT Bank, and a couple of others, right? How do you set them up, and how do they start communicating with each other?
Great.
From just an overview.
Yeah.
And then once we do that, we can then now go into now look at the how our payment flows from party A to party B.
Okay, great. So first thing is each financial institution hosts a node, a blockchain node, right? That node is integrated into their own legacy.
And just to interrupt you, how should someone think of a node? Is it just like a database, or payment?
Yes.
Just give us an overview of what a node is, just for those who may not be really conversant with blockchain terminology.
Absolutely. So basically, blockchain is it's a network of computer systems that hold a copy of a data, the same copy of records, right? So multiple copies of the same records. Yes. That's what the blockchain basically is, right? So a node is one of those copies that has the most accurate version, the same version of the transaction records. That's what a node is. In our case, we also attach what we call a connector to a node. So a node is a typical record from the blockchain, plus the connector that allows the financial institution to interact with the network, either inward or outward. And so together, that is what a node is, right? So as you know, financial institutions have core banking systems or card management systems, and then you have the blockchain node itself, and in the middle you have this connector, right, that sits between this node and those legacy systems. So that's what is deployed within each participating financial institution, whether it's a bank or a fintech. For the most part, banks prefer to deploy this within their own data centers. And that's because banks have invested heavily in their own sort of private data centers. For most fintechs, they are more cloud native, so they prefer to provision servers on the cloud and this is deployed within their cloud environments as well. But all of these things connect together into one network once they're deployed. We've made provision for what we call shared nodes for smaller institutions, smaller non-bank institutions who may not want to host a node for themselves. There are shared node options where they can connect directly to, but 80-90% of institutions prefer to have their own node so that they can control the throughput and uptime and so on and so forth. And so this is from a deployment point of view. Now, there's an observer node that sits within Zone. The observer node does not process transactions, but it serves for Zone to be able to generate reports and submit to the central bank for different regulatory purposes, right? Including settlement and other reporting requirements, compliance and so on that we need to do. So that's what the observer node does. And so this is like high level, the architecture. Now, using this architecture to think about the process flow of transactions, there are two directions a transaction can happen from an institution. One is outward and the other is inward. Outward, for example, for a POS transaction means that an institution is originating a transaction from their POS terminal, and the destination of that transaction is the issuer bank. That is the bank that issued the card that was used on the POS. So the transaction comes in, and because every node knows how to route transactions to the issuers, there's no reliance on the central entity to do that routing. So once the transaction hits the node of the institution, that node is able to find the issuer on the network and send that transaction to the issuer to authorize, right? At that issuer, that transaction becomes like an inward transaction coming in from their node through their card management system to their core banking to authorize and back, right? Yeah, so this is the typical flow for like a POS. It's different for like a funds transfer, right? A funds transfer, the initiation is an outward flow, right? From a customer who initiates, say, on the internet banking or mobile banking, so I want to send money to this account. The bank would debit the charge customer's account for the amount and some fee, and then initiate this transaction, which goes into their node as well, and again finds the receiver bank, right, or the beneficiary's bank, in the same way it found the issuer in the case of POS.
Let's have a practical transaction. So I'm a customer with, let's say, Access Bank, right? So I have an Access Bank card, right? And I'm swiping at someone whose account is at, let's say, GT Bank.
Yes.
Right. So when I swipe, right, and when I swipe my card, it captures that, hey, this is Samora, is an Access Bank client, and he wants to pay 100,000 naira, for instance.
Yes.
So the first thing, that information goes to Access Bank's node, right?
Yes. Absolutely. Yes.
As my bank,
yes,
right?
Absolutely.
So it goes to Access Bank's node, and that node, or just that simple like database says that there's this transaction of 100,000 that has been initiated by Samora, right? Then it goes into their card systems and their core banking systems, and it approves, right? So then it says Access Bank has approved for this payment to this GT Bank merchant, right? So on Access Bank side, it's like this payment is now going to GT Bank.
Yes.
And we've approved it.
Yes.
Then now a communication goes to GT Bank and says, hey, listen, we are sending you 100,000 that is to be credited, or at least, this money belongs to this merchant, let's say Obi.
No, sorry, you missed the flow. You missed the flow. The bank, the card holder, did you say Access or GT? The card holder is
Access.
Access.
The card holder is Access.
Yes. So the transaction happens on the GT POS. So it first goes to GT's node, not Access node first. It first goes to GT's node.
Got it.
Yes. actually. So the card, even though it's an access card,
and then just
the
walk
card,
us through
even
that
though it's an
100.
access card, yes,
Yeah.
I know it's an access card. It goes to GT's node. GT's node sends it to access. It's like a request. It's saying your customer is requesting that you pay me 100,000. Please approve. Yes. And then GT approves, says, I've charged the customer, confirms that it's the customer using his PIN, because the PIN that the GT cannot take access word for it, because or access cannot take GT's word for it. They need to confirm using the PIN. Once they do that, they charge the customer's account and respond back to GT saying, successful, done. Yes. Now that process of saying done,
No, just continue. Continue.
That process of saying done is also an instruction on the network to move the value to Access Bank. So it's a response, but there's also a settlement instruction that goes along with that response to say, I've authorized this payment for this customer, which means that I'm also instructing that money moves to GT. Yes. That's the flow.
Got it. And now, how would a similar transaction operate through the existing kind of centralized, either it's an instant payment system or a switch, and then, maybe point out the failure points that says, like, this is where this thing is failing in this switch, and this is why it's much more faster on this. I mean, at least much more reliable. These are the things that are happening in Zone, and these are the things that are happening in this switch. And therefore, someone can now understand, I see why this fraud rates are much lower. I see why this transaction rates are much lower.
Okay.
So maybe walk us through how that similar transaction would happen on a switch.
Okay. So the typical switch, similar thing. The customer, Access Bank customer, puts their card in the POS. The POS connects to GT Bank, what is called a TMS in their environment.
Yeah.
Then they route that to the switch, because in the old architecture, that TMS doesn't know how to route to the issuer. Doesn't know. It only knows one route, and that route is the switch. So everything that comes, no matter which bank, sent to switch first, right? Only the switch knows how to reach the issuers. So when it comes to the switch will now say, okay, this is GT, this is Access. Then it sends to Access and all the way back. This means that when that switch, it's only that switch that knows how to route. If you do a transaction and that single routing system is not available, then GT Bank cannot reach Access Bank to authorize that transaction. Yes. And they have to wait until whenever the switch comes up, right? In this architecture, when a customer from UBA, for example, comes with their card, the same GT system will route to UBA. If a customer from First Bank comes, the same GT system will route to First Bank. Same thing, Access, same thing, Zenith Bank, right?
Yeah.
If Zenith Bank is down, then Zenith Bank card transactions will fail until Zenith Bank becomes available anymore. But in the meantime, GT, Access, First Bank, and UBA will continue to process successfully, right? And this process happening in GT happens that way in Zenith. It happens that way in Access. It happens that way in First Bank for their own POS terminals. Yes, this is the process.
So that's where that's where now the difference comes in. It's like, as banks, we need to focus on our availability and our transaction processing, right, and our nodes, right, and that's the thing that we need to focus on. And if you focus on that as banks, then the failure rates from a system perspective reduce, as opposed to now relying on this on this network.
Yes.
Then I'd imagine, secondly to that, is that we all have nodes, right, and therefore, if a transaction fails, both GT and Access are accessing the same copy of information.
Absolutely.
And they can see where things went wrong.
Yes.
right?
Yes.
And
Yes.
can instantly fix them,
Yes.
as opposed to maybe they might have to wait a day to get information from the switch
Yes.
to say like, yeah, this is where transactions went, and that kind of like
Back and forth.
delays or
Yes.
something back and forth is what now actually causes actual losses to the
Yes.
banks, and potentially that's where now the architecture, the difference in the architecture comes in. Have I captured
Absolutely. You're
accurate?
spot on. That's
Yeah,
exactly how it is. Yes.
got it. Now, in payments and especially in like blockchain based payments, there's this issue of they call it the blockchain trilemma.
Yes.
So you have to manage three things.
Yes.
You can either have scalability, you can either have security. I mean, you can either have two of scalability, security, or
Or
decentralization.
decentralization.
So if you choose to focus on decentralization, then you kind of you have to sacrifice one
Yes.
of them, right? So for banks to onboard onto Zone, you have to give security and scalability. Otherwise, they won't. It just doesn't work for them,
Yes.
right? So how then do you square the decentralization question? Because what it seems to me, and maybe it's a philosophical question, what it seems to me is that in as much as the nodes are distributed, there's now a failure point on Zone. Like, have I captured that? Like, because you're the one who's now licensing these people into the network, right? So does that kind of weaken the decentralization argument, or how do you think about it?
Okay, so I think the decentralization argument, you're right, absolutely. There's some compromise, but the compromise is more tied to the fact that it's a permission network, right? So it's not like a Bitcoin, for example, where you have tens of thousands or hundreds of thousands of nodes, right? And those nodes are doing what you call proof of work. So their validation is, a very, very cumbersome process, right? And very decentralized. But it's that way because it's more vulnerable, it's open. I can go to the internet, download a Bitcoin node, and start to sort of validate transactions, right? Where the compromise is here is we've defined something we call a regulated blockchain. Yes, the concept of regulated blockchain means that it's permission. You can't just go join the network. It's not even possible physically. You can't get onto the network because it's even a virtual private network. All right. And so the only entities that are allowed to join the network are licensed financial institutions. So it kind of limits the decentralization, within the context of the ecosystem that already exists and the regulator. Right. So that's where the compromise is. Yes. But it's a compromise that also works for the regulatory angle, because regulators are not comfortable with public chains because of compliance, right? So it's a compromise that allows you cater to the compliance concerns of the regulators while limiting the decentralization, having enough decentralization, right? But limiting it to the extent that it doesn't impact on your scalability and the security side.
It seems to me then that it's a clever approach to having decentralization. And what you're saying is that, listen, you can't open this up to everyone. That's not going to build trust.
No.
From the people that matter. Like if you're trying to actually make blockchain-based payments networks be accepted by central banks,
Yes.
you have to put some guardrails,
Yes.
right?
Yes.
And the guardrails is having a licensing system that now onboards who the node providers are. In this case, licensed banks or licensed fintechs.
Absolutely.
And by doing that, then you kind of like deal with the trilemma,
Yes.
right? You're saying that such a system will have scalability and security, right? But you'll decentralize only enough that you have the right kind of partners at play. And I think what you're calling it is a proof of authority as opposed to either a proof of work or proof of stake. And the authority in this case is the licensing. But still, you're the key guys. Like you're the key guys, and you're the ones who bring these people on. And I think that's why you got now a switch license.
Yes. So
And so I'd want to talk about two things, right? Like before you go in, and you can jump in. Number one is that the switch license, how you interact with the central bank, and this whole idea of now smart contracts around compliance, because you raised the issue of compliance. So how all that all fits in together such that the central bank and the authorities trust Zone.
Fantastic. So I wanted to first say that today it seems like we're the key guys because of the licensing, the regulatory regime that exists. There is not yet clear regulations for decentralized finance. That's what we are working towards in the long run, to have regulated DeFi. Right? In the world of regulated DeFi is slightly different, right? So think about, just temporarily take Zone out of picture, Zone as us, the promoters, right? What you have is a bunch of collaborating institutions and regulators. Regulator approves joining the network, you apply to join, they will vet whether you are whether you qualify. If you do, you join. The management of the nodes as well, we are working on something we call certified system integrators and certified system administrators that allow participants to autonomously manage their infrastructure and plug into the network, do the integrations, all of that, right? So in that model, technically the role Zone plays like a developer. It's still a decentralized and regulated network where it's not like somebody owns the network here. So that's where we're evolving to, and so that's where things are going. But for now, in order to start in a pragmatic way, and I like the point you made where you said this philosophical argument that what matters is the outcome, and we took that approach with blockchain to say we're not, anarchists, like evangelists, sort of like DeFi anarchists and evangelists. We're not anti-government, right? The whole thing that started blockchain and so on was a kind of anti-government and anti-authority pushback after the crash in 2008.
Yeah.
Yes, and I appreciate
Precisely.
the motive for that, but that's not what we are. Sometimes when we deal with these crypto evangelists, like they look at us like snitches or something, right? But not that we're snitches. Yeah, we're just,
You're traitors.
yes, like traitors, but we're not. We are just pragmatic.
Yeah.
To your point around how do you use the technology that's been invented to solve practical problems. And so in that spirit, when we started, we said, okay, fine, even if we need to align with a more centralized regulatory regime like a switching license, if that's what we need, then let's do that. Right? I know it makes us look like we're a bit in the middle of the stuff, and we're okay to seem that way in the interim. But at least you're able to start, right? The ultimate goal, like I said, is the concept of regulated DeFi. And that's where that final question comes in, the concept of smart contracts for compliance. Today, the regulatory compliance, regulatory compliance is more manual. So there are things they expect us to do, submit this and that and that. It's very discretionary, if you ask me. Right? So what we are preaching is the concept of regulated DeFi and regulated blockchain is that you can take those compliance requirements out of the hands of people, like people's discretion, and implement them as smart contracts. Yes, we don't fully have that. We have it partially for a particular regulatory function for payment terminal service aggregation, which we partner with NIBS to achieve. So we do have a bit of that, but it's not where it needs to be. Right? Yes, today we're still just complying with the more manual regulatory requirements that have been set for switches. Nigeria.
Yeah. And so, you said that you haven't onboarded all the banks. I think so. I think you're still onboarding.
Yes.
You've got quite a good number on
Have
board.
a good number.
And so right now, and you're also working with NIBS, if I'm not wrong. So there's an element of competition, as they call it, right? So how do you pitch to banks, And how do you position yourself to the existing payments players such as Nibs and Interswitch?
Yeah. So I'll start with the second question first. For NIBS, the competition really there's no competition except in one channel or use case. NIBS does not actively process ATM transactions. They don't process POS transactions. For POS, they serve a regulatory function, the payment terminal service aggregation. So there's no competitive aspect of those ones. Where NIBS is really active in switching is on account to account transfers. Now today we are already a major NIBS partner for POS transactions because they are playing. We have decentralized the PTSA function on our chain, so they are a partner. We have not yet launched our funds transfer product, right? So we don't have that product today.
Yeah.
And so the way we think about it is we are open to partner with with NIBS as the sort of national central switch, right? In rolling out a decentralized version of the existing centralized funds transfer solution that they have, right? We've not gotten to that point because we don't have that product, right? So the products we have, NIBS is not playing in that area at all or intending to. Now, when you come to the other switches like InterSwitch, right? It's a little simpler because we've not needed to partner per se. Yeah, well, it's more or less it's more competitive in the sense, right? So InterSwitch has customers are targeting, we are also targeting. Yes, we've not seen any need. We are open. We are open. Once there's an opportunity to partner, we're happy to partner. But so far, we really haven't seen a need, and so we just deliver our services. They have services as well. Customers will obviously choose which service they want to use, depending on what works better, right? And so that's that. In terms of engaging the banks, like I said, the engagement with the banks. We didn't go deep into blockchain and the architecture and the design and all of those things because many banks may not fully understand it. They just have a high level impression about blockchain, that blockchain is a powerful technology. That's it, right? So the engagement is more around the principle of disintermediation. Bankers understand disintermediation because they are commercial people. They know the meaning of a middleman. Like if you say middleman, they know what middleman means. If you say you're taking away the middleman, they understand that taking away the middleman most of the time would remove some kind of burden or baggage and make things more efficient. And so that's the engagement we've had. And I think the banks were also significantly encouraged by the backing of the central bank. So even though banks were very excited, they were concerned that, they don't want to get hammered by their regulator for trying out something. And there's this whole thing of crypto versus blockchain and so on. And so when the central bank licensed us and gave us the approval to proceed, that also banks were excited to see that, to say, okay, fine, this means I'm okay. Yeah.
And for banks, there's quite a number of people in the bank that matter. So there's the tech guys, there's the payments team, there's the senior executives, and you can sit down with, let's say, the CEO of Bank A and say, you're taking out the middleman and this will lower your cost. But there are people in the background who have cut their teeth working with switches and everything, and so there's a sales process that has to be done, and kind of like a demo process that just now really now drives the buy-in between the more technical buyers who have something to lose if anything goes wrong. How do you guys manage that entire process? From first pitch to kind of like having a pilot and then having them now on board, and what are the key objections that you typically have to deal with?
Okay, lovely. I think before I jump into the process, I think I want to mention that an advantage I think we had is having being in the industry and having those banks as our clients.
Got it.
Yes, from Appzone.
Yeah.
So basically, all of the banks were already our customers. So we really had the relationships, and there's a bit of credibility and trust. And you just believe, like, so the issue is we deliver solutions that are already working, and we don't have a track record of any failed project or failed product. So they just believe that if these guys are selling something, it probably makes sense. So we had that. It's a good advantage.
And that's a huge point.
Yes. But then over and above that, of course, like you said, the first engagement is the introductory point. You just say, hey, there's the idea. And it comes from the product. It typically would come in from the sort of business owners or product owners, because they are the ones that own the customer. And they're the ones that have the biggest thing to gain in terms of either value to the customer or cost saving or whatever. So they now internalize it. Typically, they might want to have a smaller meeting initially to bring in some of their own other team members to critique. When they're comfortable, then they want to set up a bigger presentation to now bring in other departments, operations, IT, compliance, risk, infosec, and so on, into a big house. Right? Those guys would ask questions from their own, from what concerns them. So the IT guys would ask about the server requirements and why the architecture is a certain way. Compliance will ask about CBN and approvals and so on. Operations will ask about settlement and reconciliation and so on. InfoSec will ask about security, you know. And so the once that is done, and if they are comfortable, right? Typically, what you might find is that even after that session, one or two departments may not be fully comfortable, and they may have reservations which they couldn't express because of time. And so you may have to take subsequent, meetings with specific departments to say, hey, this is some other issues I had, and to kind of address them and so on. The typical pushbacks you hear at those times are the compliance guys around crypto and blockchain and whether CBN sanctions this and so on. You'd hear like the security guys around, what is this exposed to the internet? It's a public chain, is it a private chain, is there a VPN? All of that. The operations guys that want to see the process, the settlement flow, and they want to also see that this settlement process aligns with what is approved. So they are thinking, I hope when we run on this blockchain, you're not now going to set up a separate settlement process on the blockchain. Not that it's not efficient, but they know that there's no approval to do that. So you have that. Of course, the business guys are looking at things like commercials. What's the cost of this thing? What's the cost to us? Is there a setup fee and so on and so forth? So all of that.
Right. Yeah.
So when you address all those things in subsequent meetings, then the business guys are then able to draft an approval memo. Typically, the business guys before this, they're going to come back for one last final negotiation. When they see that everybody in-house is good, because they don't go too deep into the negotiation initially, just hint. But when they now see that this is something the bank is willing to do, then they come back for a final alignment. Okay, what does this whole thing cost? What are we going to, and all of that. Once they align, they take that and put it in a memo, to a justification memo, which will still go to those different departments to approve, to endorse, right? Yeah. Once that's done, and then it goes to the top for final endorsement, then we start the project. So we start the project and start the legal documentation in parallel. We typically would not wait to do the legal documentation before the project starts. Yes.
Got it. And from all those objections, so compliance, it's a typical compliance objection that will be raised, but they're very clear answers. For InfoSec, I think you're running on VPN, so again, very clear answers. The one that has stuck out for me is the Appzone, right? Because these guys have manuals that say how clearing should be done, and some of these manuals, it's hard to change them, right? And especially if you're part of a group, such as GT Bank, where you have group policies that cut across multiple countries. And now you're actually proposing a fundamentally different way of transaction processing and settlement, right? So it seems to me that is the biggest hurdle to kind of jump. Is that your experience, and how do you actually now deal with that from a
Yes.
policy
Yes.
perspective?
Yes, you're right. It's usually the biggest, always one of the biggest, but usually the biggest. And so what we do is we start by highlighting the enhancement, right? And the enhancement is mostly about automation.
Yeah.
The biggest change we could make to settlement we have not done yet, and that is to have the set, like you said, merging reconciliation, communication, and the settlement on one system. We have the settlement accounts don't yet sit on the chain. They do, but they don't function that way yet because we have not aligned with central bank to do that. That's a big shift to move the settlement accounts from RTGS into the blockchain. Because we've not done that officially, we effectively will still, even though the settlement happens on the chain, we effectively will still mirror those records into the central bank system on a daily basis or multiple times a day.
Yeah.
Yes. So in that fundamental way, the settlement process is still the same. What is different is the operational activities inside the bank. And the difference is usually down to automation. So what we show them
Which should
typically
be a
is that,
benefit.
yes, like this is just, we're automating what you would have done because we have the source of truth from the data, from the blockchain. We're able to just automate a whole bunch. Sometimes it elicits a bit of fear of, does this mean my job is not, like, are you, like, is this kicking me out, right? We try not to focus a lot on that, but basically the explanation that people understand and see the efficiency is that, look, this is automation and you can do a lot more with this tool, and that works.
Yeah. One of the things you touched on was now, discussing commercials, right? So how does Zone make money?
Yeah, so basically it's a transaction fee model, the same way switches make money, essentially. We do not, originally there was a fee, like implementation fee and so on, but in order to like move faster, we kind of waived those fees and subsidized implementation cost at end. So it's a transaction fee model.
And what are your general fees, like, at least ballpark range in terms of basis
Yeah,
points?
so in basis points, so you have some flat fees, you have some fees that are percentage. You can go anywhere from about 20 basis points up to 50 or 75 basis points, right? Depending on the use case. Some percentages have a
The
cap.
nature of the transaction.
Yes, the transaction type. Some use cases have a cap on what the absolute amount to be, while some are flat. Like, okay, just a flat fee. So it's blended that way.
And one of the things that I wanted to touch on is that you're still very early, right? I think you raised your seed round. Is it a couple of years
Yes.
ago? It's like $8 million.
Yes.
And if I'd say, like, your true North Star right now is driving more trust and driving more transactions, right? Now, one of the things that, if you look around the world, whether it's Visa, whether it's Swift, whether it's some of these blockchain initiatives that you're seeing in Europe, such as there's this one called Finality in Europe, there's this idea of, like, payment systems working as consortia. Because fundamentally, your job is to set up rules, and you say that you're going to do less of the infrastructure, be less of more of like a software company, which is basically rule
Yes.
setting, right? And sitting in the middle and setting rules. And so, it seems to me that one way of doing this is actually having a lot of these participating banks as shareholders. And that now should see them now driving more volumes, right? Because they've got something to benefit. Would you agree with me? And do you think there's some value in having kind of this kind of participation beyond just a node? And is there any conflict with that being a VC funded company, specifically when it comes to the sales cycles and the scaling of the company?
Okay, so no, it's an interesting question you asked because we've actually thought about a lot of the time in strategy sessions. First, we are obviously open. We try to again be very pragmatic with everything we do because that's how to deliver value. So we are very open to the idea of like those type of the consortium investing in the entity driving. We're open to that arrangement. It happened with InterSwitch. NIBS is partly owned by the banks as well, and so on. That's on the one hand. We also look at what is happening in crypto, right? If you take Ethereum, for example, you have you have participating members of this decentralized network, but you also have developers that are responsible for sort of building. They don't determine what goes in. People still have to vote for a change, right? But the actual work of designing the logic to enhance the network, yes, you have that. If you take Cardano, for example, Immorgo plays that role. If you take Solana, for example, you have that. Ripple, like it's not out of place, right? Where there's a role for like a developer, network developer. They don't control it from a governance point of view, right? The governance is still decentralized, but the actual enhancement work is handled by an entity subject to governance. And so that's another approach in terms of ownership. So in the way we see it, as we transition, we don't have that decentralized governance today. The governance is mostly within zone because of this licensing regime. Because the central bank expects us to manage that governance. That's why we are licensed at the switch. And that's understandable because we're coming from a centralized world. But where we are evolving to the concept of regulated DeFi, we expect that we step back from a governance point of view and then managing the deployment and infrastructure and all that. And so in that decentralized governance arrangement, basically owning a node is like it's like being a shareholder in a way, because you own part of the network. Like nobody owns the network. You own part. Decisions are subject to voting and regulatory approval. We are just a developer. Yes. So taking shares in developer is like a disconnected thing. Like you can do that if you want, but it's not central to the network. Yes. So that's another view. Yeah. So if we are leaning in the direction of DeFi and adopting the way DeFi works, then it's going to lean more in this direction where, as an entity, we're just the developer and original promoter. It's not our network. Everybody who has a node owns a portion of that node, is a portion of the network. Yes. So that's another way.
And so basically what you're saying is that you kind of have to balance, and there are two things to balance. There's this idea of continuous innovation, which a developer brings in. And if you go full consortia, then you're sacrificing this continuous innovation.
Agility,
because now what are the incentives to keep improving the product? So there's a universe where you have like the best of both worlds. And if you actually think about it, it's premature to answer that question now, given that you're so far, you're in kind of like stage one, and there's still now the idea of like a fully regulated blockchain and more adoption. So that's a question that you can answer, much later.
Definitely.
Exactly. And, and now another thing I had is that um, we are seeing a lot of growth in the likes of OPay, PalmPay, MoneyPoint, and these fintechs, especially around POS merchant kind of use cases, and growingly funds transfer. Um, and all these guys are trying to build, maybe but the value, the kind of North Star is having this closed loop payment system where money point transactions are operating within the money point ecosystem, and similarly for OPay, right? So when you approach them, I'm sure you get this kind of latent barrier where, like, we want to work with you, but in the long term, we want people to be transacting within our ecosystem. Um, is that true? And how do you now look at this market? Is this something that you want to go and get, or you just say let's focus on banks because these guys are trying to build
No,
closed loop systems? How do you
no.
manage
Well,
that?
actually, so to your point, that's the kind of direction that typically those hyperscalers in that area think about. You can take the extreme version of it when you look at something like M-Pesa or some of the big mobile money
Precisely.
guys in other African countries. Um,
Yeah.
but
Yeah.
here, yes, that is the ideal North Star, but the sort of competitive nature and the fragmented and commoditized way that financial services is makes it such that it's just going to be very difficult for one player to just own all the customers. And so, yes, that bit is something that the interoperability is always going to be a requirement. So what we are doing, we've engaged with those fintechs. We didn't engage initially because we launched using the ATM channel, and most fintechs don't deploy ATMs. But when we launched POS,
Yeah.
it opened up the engagement with the digital banks and so on. As we speak today, we've signed on PalmPay. PalmPay went live recently. OPay went live recently.
Yeah.
MoneyPoint is currently integrated as we speak. And some of the other guys like OnAfric, so Baxi, OnAfric, but acquired by
Yeah.
OnAfric, formerly MFS, Paga.
Yeah.
Yeah, so all the names that you can think about plugging in to join the banks on the network. Today, we have maybe between over 40, closer to 50 participating institutions, more of which are like the tier one and tier two
Yeah.
fintechs. Yes.
Yeah.
Yeah. And so that's yeah.
And now going to the next step, I think, last I checked, you're doing around 1 trillion so far. From the beginning. I'm sure it's up by now, but I think there's a Tech Cabal report that
Yes.
came in that said
Yes.
you're doing 1 trillion total transaction
Yeah.
volume. The market is at one quadrillion,
Yes.
so that's times a
Yeah.
thousand, right? Um, and so what's your midterm goal in terms of volume? Actually, even before going into volume, like as Obi, as a CEO, what do you look at as these are the most important metrics I have to manage, and these are the key things I look at to gauge the success of this company? Because sometimes people may look at TPV, but that's not the key
Yeah.
metric. It may be something else. From your experience, what's the key thing that you look at?
So TPV is part of it. Volume, transaction volume, which is count, is part of it. The
Yeah.
use cases, that's the products that are active and live. The use cases are the different channels. So we started with the ATM. We launched the agent POS. We're launching the merchant POS. So it's POS for two different use cases. And then we're going to be
Yeah.
launching the funds transfer, as well as what we see as our most innovative use case, which is our sort of mobile payment or pay by bank use case, where we're going to be using, so basically allowing customers to use their mobile banking applications to make merchant payments using deep linking, the deep linking feature to pay merchants in a very
Yeah.
very, very delightful experience, right? So what I mean is today for funds transfers, you'd capture an account, and so on, type in all of what you need to type into your bank app to be able to do, and then log in and so on and so forth. But where the deep linking feature allows you to tap on a link or scan a QR with your camera, right? And then through the deep linking integration, the banks are listening for that. And basically, that link opens your bank app and pre-populates all of the payment details directly on your behalf. And you just put in your PIN and pay yes. Right? On the merchant side, it solves notification. So that way, we're able to sort of notify or help merchants confirm payments even though they didn't initiate it from their own devices, right? And also solve reconciliation. So the big thing with transfers, using transfers to pay merchants, is that transfers don't carry details of the transaction, what the transaction was for, and it's a big issue for reconciliation. Our own, we call it Zone Pay, is gonna allow within that payment link capture descriptor metadata describing the transactions, like an order ID or a product ID or a customer ID or a terminal ID, whatever, inside there, so that that thing is part of the payload that is transmitted as part of that transaction. And after the primary bank transaction happens, which is to like debit and credit the customer, that additional payload is sent to the merchant along with the transaction for them to reconcile and know that this is what. So it solves the experience on the payer's point of view, and solves the notification and reconciliation from the merchant's point of view. It's applicable across both merchants on the web or in-app or in-store. So it's going to be interesting as layered on top of this sort of architecture. It's also more reliable because it actually takes out the receiver side. So what we do is we create wallets for merchants on the blockchain. And so once the first leg of the transaction is done, the transaction is done. It doesn't go to the next. It doesn't, like the description I gave you of going to the receiver node, it doesn't touch the receiver node at all. The money stays in the wallet. And then there's what we call a liquidation process that can happen manually or be automated at intervals. So it's like 100%, like it's the air. So for me, the one key metric is rolling these things out, right? And so the impact on the transaction TPV and the volume, but also the network size of the participating members, banks and fintechs. Yes, those are quite important.
And the Zone Pay looks interesting, and I think you'll get a lot of interest specifically around large merchants, because I know for large merchants usually the payments reconciliation is usually the headache. As a small kiosk, it's fine, and I know you paid me, but sometimes they want to understand product details and all that kind of stuff. So it makes a lot of sense. Now, given this TPV, the final outcome of all these things, increasing your network, increasing the products, should be numbers, TPV, and volumes, right? So, where do you see yourself like in a couple of years' time, 5 years' time? What does success really look like for you?
Yes. So the way we think about it, and I'll start with the qualitative aspect before I go to the quantitative. From a qualitative aspect, the strategy is like this: start domestic, then expand into a regional network through the remittance use case. In the remittance use case, we're infrastructure, we're not customer facing. Our clients are money transfer operators or digital banks or commercial banks. We're solving for one, the settlement layer, real-time settlement with a settlement token, like a kind of permission stablecoin. We're solving for the real-time integration to credit customers in local currency. And we're solving for the regulatory licensing across all the jurisdictions where we operate. We are open to partner with licensed money transfer operators in each jurisdiction, so we don't need to go get our own license, right? But we solve for this, aggregate this together. We also solve for compliance within this this infrastructure layer, decentralized infrastructure layer. But for each of those countries, it's also an entry to be able to replicate the domestic play in that country. So once we get a corridor going, Then we go deep in that corridor to be able to say, okay, the POS and funds transfer and so on and so forth we've done here and Zone Pay, we can do there as well, right? But on top of that, we also know that we can extend the capability of this network to go beyond payment, actually, to enable other financial services like lending and savings and so on. But in a arrangement where you can have retail wallets on the chain, actually, right? That's now going towards regulated DeFi, right? Where working with central banks and central bank digital currencies, right? Enabling digital currency adoption through wallets on a regulated chain that are integrated to the existing payment rails that same regulated chain has deployed, and providing interoperability between these digital wallets and digital forms of money and the traditional bank accounts with the traditional money sitting in there. Interoperability, clear interoperability and compatibility between both. Yes. So this is what we're trying to do on a not just Africa, but we see it as an emerging market. We see it as an emerging market play with Africa initially, and then some of the other emerging markets.
Yeah.
Yeah. So this is a qualitative view.
So you've
Yeah.
got quite a yeah. Yeah, you want to speak about the quantitative?
No, so from a quantitative point of view, we don't always think of it purely
It will
TPV
take care of
because
itself. I mean,
yes, exactly. And because the take rates vary. So TPV, so I'll give you an example. Sometimes you might have a lot of TPV, but the take rate for that TPV is not, and then you might have a smaller TPV with a higher take rate. So it all varies. You know, it's more of
yeah.
how this translates to revenue, making sure we're profitable and you're scaling quickly, making sure that you are delivering. We're having that broad impact, transforming the way
Yeah.
payments and other financial services work through this move to regulated DeFi, and just delivering a better experience to end users.
Got it. And it seems you've got quite a bit on your plate. And what do you know now that you wish you knew a couple of years back?
So yeah, I mean, I would say the the nature of integration engagements for payments with banks, right, is something that we're learning, even though we've worked with banks. But we're also learning that, even when you close the pipeline, like they're closed and everything is good, right? The project, the kind of implementation processes can be,
Yeah.
yeah, quite can take quite a while and be fraught with one bottleneck or the other, which you overcome and then go live.
Yeah.
So that's something that is kind of different than how we would have thought about it.
Yeah. And being a VC funded company, it must make the board meetings quite interesting.
Yeah, of course, you need to carry.
Explaining that the deal has closed.
Yes, yes,
The deal has closed, but not seeing
exactly,
the
exactly. So there's an expectation that they've closed
yeah,
this and then but I think it's all about carrying investors along and being clear about
yeah,
what the opportunity is. Also, there's a bit of a credibility
yeah,
thing to it as well. When you're as a founder
yeah,
who has track record, investors tend to rely a lot on your judgment and so on because they're looking at the track record of other things you've built.
yeah,
So
yeah,
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 we've
yeah.
had good investors so far.
Got it. No, Obi, thank you so much. I think I have a much clearer understanding of Zone. I have a much clearer understanding of the idea of regulated blockchain. Thank you so much for coming on the podcast. and relatively short notice. And I know you've been traveling quite a lot of late, so thank you very much for making time.
Pleasure.
And yeah, man, thanks for joining.
It's a pleasure here. I mean, it's lovely, especially always a pleasure speaking to, people who kind of have a good understanding because it helps to make the conversation just a lot
Yeah.
more fluid. So it's been a pleasure as well. Yeah.
Thanks, man.